You are listening to Wealth Talks, where we talk about solutions, money, and other things that create wealth in your life. John, welcome back to the mic here.
Yes, it's great to be here as always. And today, Mom, or Michelle, is also with us.
It's always good to have you, Michelle.
Thank you. And Tom, you actually announced the podcast very well today. I wasn't sure how that was going to come out with your voice kind of going squeak, squeak here and there today. So good job.
Well, thank you. It's always good to be here, even if my voice isn't completely here with me.
So what's up today? What are we going to talk about?
Yes, so we have something we want to talk about today. Let's say you are following the 10-20-70 rule.
Okay, so 10% to savings, 20% to paying off debt, and 70% to living expenses, your lifestyle. Yeah.
That's right. So you're following this pattern, no more than 20% to creditors, but you're saving 10%, and you read something online that you should be saving 15% or 20%. Well, does the 10-20-70 just go out the door? No, you're doing something right, and we're going to talk about why that's the case here today.
Well, first of all, I just want to say that the average savings rate in America is between 4 and 6%. So if you're doing 10%, you need to pat yourself on the back right away.
There you go.
Because that's a huge amount more than what most people are saving. But you're right, John. 10% is not going to produce enough money to sustain us in retirement. It just won't. Statistically, if we're used to a certain lifestyle and we're only saving 10% of what we're making today, we're going to live at a different lifestyle when we retire.
Yeah. So what you're saying is while saving 10% is a good start, it's a start. It's not where we want to end up eventually. So how do we take this 10-20-70 and starting with savings 10%, but how are we going to get to where we need to go? Is that what you're going to talk about?
It's right built into the 10-20-70 system.
Okay,
You start out by saving 10%. But what about that 20% that's going to creditors? You don't want to continue to pay that for all the time. That 20% is a built-in booster to your savings.
How does that work, John?
Once your debt is paid off, now that 20% becomes 30% of your savings.
Good point.
That's something we can do something with for the future, big time.
And also, you've got the 10%, you've got the 20%. Sometime, even before that 20% of debt is paid off, some of that 20% might start moving towards that 10%.
Oh,
Depends on the situation. Sometimes we might continue just to really pay off the debt with that 20%. But sometimes we need to start moving some of that 20% over to that 10%.
And whether it's coming back to you or you're using that part of that 20% that you're freeing up to accelerate debt reduction, it's still benefiting you in the long run because we're getting rid of what's stealing the 20% from you.
Yes.
And that's where it comes in. And we've talked about this before on the podcast. But if you have a student loan or a mortgage that's included in your debt, you may not want to tackle those things right away. They're like trying to eat an elephant. It might be 20, 30 years that you're working on these things before you can get it paid off. We want to get that 20% over to be added to your 10% savings right away. So you can have a 30-70 as soon as possible.
Good. And I just want to speak a little bit more about that mortgage. If you're really going to try to pay off that mortgage, you could be missing out on the accumulation of a lot of assets during that time. I mean, the mortgage company is satisfied with just the amount of mortgage that you have or the amount of payments that you're making. And yes, you'll pay more for the house in the long run, but what kind of assets can you also build for yourself during that time?
Well, that's one of the reasons that you need to be at the Wealth Summit this year, because we're going to go over that scenario in detail to find out whether or not paying your house off early, like many professional gurus and financial planners tell you to do, or whether there's a better way to end up with more money and a sustainable income for the rest of your life that's tax-free.
I love it when you share this because it's amazing when you actually see the numbers. And so the Wealth Summit's coming up October 12th, 13th, 14th. Go to wealthsummit.net to get all the details. You can register there. You can call our office to register, 702-660-7000. If for some reason you absolutely cannot make the Well Summit, we are going to have the recording available for purchase. So keep that in mind. But
that's right. But yes, this mortgage example that you're going to be sharing, Dad, for those of you listening, you want to be at the Well Summit if it's just to hear that piece.
Yes.
It's a game changer.
It really is. It's something that I wish that I would have known years and years ago. In the past, those of you who have come have seen how we paid cash for houses in the past and how that lost us almost $1 million of availability. So you definitely want to be here to see how there's an alternative way to pay your mortgage off and have a lot more cash value that's going to sustain your living and lifestyle in the future.
All right, and now we have a question for you that has come in on the podcast.
You mean one of the listeners?
That's right.
One of the listeners. Great. One of you out there had this question for us.
That's right. So Jason writes in, he says, I wanted to pass another podcast idea to you. Thank you, Jason. I've heard a few folks talk about how they have from 30 to 60 term and whole life policies. It would be interesting to hear the ins and outs and the strategies of managing a large portfolio of policies.
Well, the first thing I want to remind you is that you should never buy a life insurance policy unless it's affordable and comfortable for you.
True.
Those are the rules that we work with. Those are the rules that we expect you to follow in purchasing a policy. So just the fact that someone else has 20 or 30 or 40 or even 60 whole life policies doesn't mean that you should. And John, why don't you talk a little bit about why it is that you shouldn't just add policies just as rapidly as it's possible?
Sure. We've talked about this a little from time to time. There are different strategies for adding policies faster than is really affordable and comfortable, such as borrowing from one policy to finance another one, such as premium financing. You have heard us talk about some of those here on the podcast before. All of that creates a snowball with an interest load on it. So that's not a viable long-term strategy unless there's another piece of the puzzle.
Right.
So what you're saying is some people finance a policy by borrowing money from somebody else and have an interest, or
premium financing.
They'll even borrow from a policy they already have to finance another one. That's just a different way of premium financing kind of internally.
Yeah, using the insurance company and your own cash values in another policy as collateral.
And you're right. You will face an ever-increasing interest burden if you decide to build policies that way. And so addressing the issue, how can you get 20, 30, 40, 60 policies? And that is because it becomes comfortable and affordable to do that. Because, Michelle, like you were talking about, that 20% is eventually going to come back to you. Mm-hmm. What do we do with that money?
Right. And, I want to say that, I get a lot of people, and maybe you in the audience, maybe you're some of these people who have this question for us. Tom and I have 8 children. And a lot of times I see people, their eyes go huge and they say, I have 1 or I have 2 or I have 3. How did you do it? And the thing is, my 8 were not all born at once. So that was something nice. But think back to those early days when you had one child. Maybe some of you started with twins, but you have that one child. You have a lot of a workload, learning how to take care of an infant. I mean, John here, he was our first one, and there was a learning curve there. And, when he was just little and in my arms, I couldn't imagine having 3, 4, 5, 6. I couldn't imagine that.
Was I harder than all the others?
Well, let's say I was less experienced. In time, we added a second one. And were there hard times? Oh, sure. It was challenging to figure out how to do 2, how to do 3, how to do 4. But, you learn how to integrate what you have and your experience, and you just are able to start doing that. The same thing can be said with policies. When you realize how cash flow is going with 1 and 2 and maybe 3, well, maybe you see an opportunity to add a 4th. And if you do, great. And if you don't, then don't do it.
I'd like to just say it's kind of like learning how to drive. Put yourself back for a moment when you were first sitting behind that wheel, maybe in driver's education, or maybe your parent was sitting in the right-hand seat, or whatever happened, and all the things that happened so fast. You were going 25 miles down the road and you thought, wow, this is really fast, but the thing is, you learned how to drive. And once you learned how to drive, was it that hard to drive the second car in the family, or your friend's car? Or even maybe you rented a motorhome sometime and drove that. Did you have to learn all those things over again? No, there's just little skills that you have to pick up after you've done the first one. So just because you're driving more policies doesn't mean that it's that much harder than driving one.
That's right. And then, how about when you get, after you've been driving for a while, pretty soon you get to work and all of a sudden you think, I don't remember much about the trip here. It becomes so automatic.
Habitual.
Yeah. And also think about you starting your job or your business that you have right now. The first day of it, you found out where to hang your coat and where the bathroom was and, what time lunch would be. And then at the end of the day, were you able to do all the things that you are presently able to do at your job or in your business today? No, absolutely not. There's some skills that you learn. There's things that you add on, and pretty soon the things that seem so difficult to do are just simple and easy. And that's the way it is when you're building experience and becoming successful at what you're doing.
Again, at the Wealth Summit that you're going to be at, you're going to hear Michelle talk about the ABCs and the 1, 2, 3s that we had in first grade. If for no other reason, that's a good reason to be at the Wealth Summit, because people that have been there say that's one of the best presentations that's there. And so as we're going through the ABCs and 1, 2, 3s of the Perpetual Wealth Code, John, one of the things that we do to make it easy to manage more than one policy is the money manager's account. So let's explain a little bit what that means to you.
Yes. So the money manager account is a separate checking account, separate from our everyday checking account. It's just another checking account, can be even at the same bank.
And it's just a personal checking account.
Personal checking account. It makes a central point for all the money that's coming from the policies, regardless which policy, to come in. That becomes the central hub of your money management system, kind of like a clearinghouse. Mm-hmm. Money goes through that account as it's on the way to be used somewhere in your personal or your business life, and it comes back through as you repay the loans. It goes into that account, and then it can be distributed back to the policies. Does it matter which particular policy you send your repayment to every month?
No, it doesn't.
Not really. In fact, when you have a large portfolio of policies, it's better to pick the ones to repay the loans first on that have the higher interest rate.
Yes.
Or maybe if it's a direct recognition company, you might want to repay those loans first so that it boosts your dividend a little bit. At least in the current environment, that's what would happen. Repaying a loan on a direct recognition policy. So that's something that you can do when you have a larger portfolio of policies. Another tracking strategy that is easy, makes this easier, is to put the policies that you own into a spreadsheet, like Excel or Numbers if you're using a Mac. Put the the information about those policies in there. The loan balance on each one, the amount that's available in those policies. You'll update it something like once a year for the policies when you receive your statement. That's a great way to keep track of what's available at any one time across all your policies.
When I think about managing money like this, and the way we use the money manager account, I like to think about a pair of cargo pants. So maybe you're even wearing a pair of cargo pants right now, or, pick the favorite one in your closet. Think about putting those cargo pants on, or maybe you don't have any, but maybe your spouse does. And think about that pair of cargo pants, and you're at the store, maybe they give you change. Where should you put that money?
Which pocket?
Yeah, which pocket? Do you want to put in one of your back pockets? Do you want to put in one of your hip pockets? Do you want to open up the button or open up the Velcro on one of the side ones or
Someplace
unzip?
where I remember where it's at.
Does it really matter which pocket it is in? Not really. It's your pants.
Yes.
Any pocket you can, put your money in. So that's kind of what I like to think about it. It's kind of the money manager account helps us to kind of put it together. And then where do we send our extra money? Does it matter which policy? No, it really doesn't.
Now, another consideration here, which is one of the reasons we have more policies than some people, is the number of people that we're insuring.
Oh, sure.
We have 10 people in our family.
Mm-hmm.
And so we have more policies to go around for everybody than an average family.
That's right.
Might.
That's right.
And we have business associates and
Certainly.
people like that we've had an insurable interest in. So, yes, it doesn't matter how the money is put back into the policy or which policy you choose. We just have the money repaying the money manager's account, that separate personal banking account, so that it makes it easier for us to, if we want to reuse that money, we don't have to go all the way back to the insurance company to borrow it again. Mm-hmm. It speeds things up. It allows us to get that 20% back to ourselves quicker to use over again. And lets us decide how we really want to use it. Maybe we do want to pay off a policy loan. Maybe we're trying to build up a fund so that we can make a bigger investment in the future on something. Or maybe we have a need for it right now in a business need, or maybe someone wants to borrow that money and pay us interest for it. That money would still go back into the money manager account as those payments are made.
That's right. So this money manager account is the central hub of your banking system. And when you don't want money sitting long term in there, though. And that's where it comes back to paying those policy loans back.
Yeah. People will say to me, I've got all this money sitting in my money manager account. What should I do with it? And, the first thing we want to look at is, well, do you have outstanding policy loans? Because the policy is going to be charging you interest. So if you just have money sitting there, why not pay it back to the policy as a policy loan repayment, and then the interest, you won't have an outstanding interest charge on that. Another place might be an outside investment that you want to do. Another place might be, hey, it's time to purchase another policy. I'm consistently having this money sitting here.
I'm so glad you said that, Michelle, because you that are listening know that a lot of people call your policies your bank. And they say, well, it's time to open another bank. Well, the bank is the money manager account. Mm-hmm. The policy is the depositor into that bank. So if we're really going to become our own banker, we have to have an account for that money to pass through. And that's what the money manager's account really becomes. Of course, we don't call it the bank because insurance companies don't like it and banks don't like it either. We call it the money manager account. And now the insurance company becomes the depositor into your money manager's account. You then get to control it and how it goes and where it flows. And of course, money under your control and flow is what creates money for you. That's why we do this.
Well, I want to go back and say something again about the 10-20-70 that we talked about. Tom, you mentioned that buying a policy should be both affordable and comfortable. And there's some of you out there that might say, well, 10% is all I can afford. And that's all that is comfortable. So, and that may be true for you. And if you're someone without debt, I would seriously challenge you to really look at, should you be living on 90% of your income and only saving 10%? The comfortable and affordable part, if some of it is just what's in our mind. What is comfortable? What is affordable? And so we're going to have to decide, is it more comfortable and affordable for us to save more than 10% now? Or in retirement, is it going to be more comfortable for us to have to be more affordable for what our 10% has provided for us? So there is that to remember.
And John, you've created a very unique situation to find out what people's 10, 20, 70 is.
Yes, we have a worksheet that you can download right here on the website. We'll put the link to it here in the podcast so you can access that very quickly right here.
Yeah, it's a great way to assess what am I spending on? Where is my money going? And then to be able to see, hey, how can I make an adjustment here or there to what I really want for my future?
That's right.
So you are enjoying the podcast. How would you like to be part of it? We would like to invite you to be part of the podcast like Jason, either writing in and sending us your ideas, your thoughts, or if you've got a great idea, we might even host you right here on the podcast live.
Or we could read it live too.
Yes.
That's right. So to do that, please email me, send your comments, questions, and thoughts to John, John, at life-benefits.com, or call our office at 702-660-7000. Thank you for participating. You're listening to Wealth Talks, where we talk about solutions, money, and other things that create wealth in your life. We'll be back here next week.